That's the RBI Governor, Raghuram Rajan, taking questions. 5-page policy statement. The press conference ran for about 50 minutes or so. And that when I think the policy has thrown up very little by way of any surprises. But of course, I mean, the press conference, the questions kind of addressing a whole host of things. They're both domestic and global. Atul Joshi is here. Madan Sabnibus is here. Mr. Vijendra Srivastav from Sundaram is here. Pradeep Chaudhary is with us from Delhi. And I've got Mr. Indranil Pan, Chief Economist with IDFC also coming in on the debate. Mr. Chaudhary, I give you the first word, sir. You heard Dr. Rajan. And
we could do so much, but did so little. That is my comment. Because, for example, you know, this marginal cost dictating the base rate. The last time the base rate came in, no such song and dance went on. In 3 months flat, the base rate structure came in. And now we have been hearing for, you know, months and maybe ages, this will come, but we are yet to see the light of the day. Similarly, on the ARCs.
He did say that I think later this week they're going to put out the norms, right?
No, but why should it take 1 year? You have most of the banks headquartered and you are meeting them so often. So now you come up with then you have a deputy governor on your board who is a former bank chairman. So why do you need to do this? And we are doing. How long will this present continuous tense continue? So the second thing is the ARCs. Now in ARCs, they're okay, promoter norm and all that you regulate. But what is the difficulty in allowing ARCs to do an IPO? The ARCs are undercapitalized, they need capital. Now, unlike in a bank where, you know, the depositors have an expectation of a fixed rate of interest, in case of an IPO, it is the investor and the investor is fairly well informed. So, why don't you allow the ARCs to do an IPO and the investor can take an informed call whether they will subscribe to the IPOs. Now, this is one single block that is holding up the growth of ARCs, and except for talking, we are doing these homeopathic doses, nothing much has happened. And secondly, by allowing the IPO to happen, RBI does not incur any liability. Many banks have done IPOs and today their prices are rolling much lower than the IPO price. Or for example, many PSUs did IPOs and the prices are today, but it is the investor who takes the hit or who gets the gain. So why should you hold up the process of IPOs for ARCs? Allow the ARCs to be listed. Allow the ARCs to issue shares in public.
Yes. You should, maybe they've not thought of it. You should write a letter or maybe
Number
make a
of them have been written. Number of them. And I think RBI would run out of storage space. But not respond.
With everyone's permission, I'd like to bring Mr. Indranil Pan into the discussion as well. Mr. Pan, you heard the conversation, the commentary from the RBI. Anything stands out to you? Anything we should take away from the comments made?
Well, I think he has been emphatic about the fact that he remains accommodative. But having said so, I think his commentary clearly painted a sort of a sideways picture. He has highlighted most of the risks that we are all aware of in terms of the global economy and the very fact that changes in the monetary policy stance by developed markets, especially US, can create investor nervousness from an emerging market assets standpoint. Which I think becomes extremely relevant at the current juncture given the volatility that might be expected in the rupee, and hence in this policy and maybe in the next policy he might not be able to do anything much. The second issue, of course, he clearly highlighted is the relative risks that are there in terms of the inflation. But having said so, he did point out also that there could be a bit of a softer bias, a downward bias for inflation in the next financial year, which to a certain extent was a bit confusing in the sense that on one side the pay commission awards are supposed to be increasing inflation both from the wages side as well as the sort of house rental side, but the RBI would want to...
Yeah. No, I'm saying he didn't sound overly bothered by the 7th pay commission when he said, well, maybe...
The RBI possibly wants to see through.
Go on, go on.
Yeah, so I think these are some of the clear issues that have been laid out. So in terms of the future direction of the policy, I think we would possibly see a sideways stance even in the February. I am personally not expecting anything in the February policy, and if anything, it would come only after the union budget and after we have seen, or even the RBI has seen, what are the attempts that the government is taking in the light of the 7th Pay Commission awards to actually maintain consolidation on the fiscal stance. So I would bet on a post-budget cut, and that might be even sort of immediately post-budget and intra-policy date.
Atul, you want to come in?
Two things. One is that if you look at when he came in, he put in CPI as the benchmark, and that point in time, about a year and a half back, he had said that the January 2016 CPI number should print below 6%, and if it does, the accommodative policy stand would continue for a longer time. And today already he's reduced that 6% to 5.8%, and today again he said that it is likely to be lower than what the earlier expectations were, which is lower than 5.8%. And given that kind of expectation of the RBI, we do expect that over the next 18 months you would either see reducing interest rates. It's difficult to guess how much more, but certainly there is no scope for RBI to increase the rates over the next 24 months, number one. Number two, he mentioned very important statement about the fiscal deficit being joint responsibility of the central government and the RBI. I would read into that the interest that the government pays on Government of India securities is now forming 40% of the total top-line revenue of the government. And there, unfortunately, I have not seen any comment about how the RBI is looking at reducing that interest burden of the central government. Having taken that joint responsibility, I guess this commentary should have been a little more elaborate on the strategies of the RBI to reduce the interest burden of the government. Committed expenses anyways are about 83% of the revenues. 40% being interest. I think RBI shares a fair burden of this joint responsibility.
You highlighted this point before, earlier in our previous discussions as well. Madan, anything?
Yeah, two things, Prashant. See, one is in terms of the policy right at the end. There's this constant talk about saying that there's need for the government to revise the interest rate on small deposits.
Yeah.
Now, I think it may be a bit of an exaggeration here to say that as long as I don't decrease the rates on small deposits, banks will not be able to do so. Because if you look at the overall total amount of small deposits, take it as a proportion of bank deposits, it's just around 5%. And if you see, most of them are in the form of committed kind of things, like your PPF. You have a limit of 1.5 lakhs. So even in case I want to put 10 lakhs, I can't possibly put it in. Similarly, if you look at the post office deposits, which probably offer higher rates than bank deposits, how many of us really do put our money in post office?
You're saying the total is 5%?
It is around 5%, which includes
5%
of bank deposits.
Okay.
And plus, out of that, another 50% is coming in post offices, which none of us actually use. So all the big savers don't really go to post offices. So to my mind, it's a bit exaggerated. And even to the extent that it matters, see, just look at this case. A number of new private sector banks are offering, say, 6% on your savings deposit. Do all of us move out from SBI, PNB and put our money in that private sector bank? It doesn't happen. So I don't think money is that flexible when it moves from one bank to another. So therefore, I think it's slightly exaggerated to say that as long as small savings have high interest rates, banks are not in a position to do it.
I want to get Mr. Chaudhary's thoughts on this, but before that, I want to just, sorry, you had another point. Yeah,
I think another thing, one thing which is missing probably in this policy statement is something on savings. Because I think in the past, whenever the RBI has not taken any interest rate action, they've always said that, look, financial savings is something which has been coming down and we have to ensure that they remain up. So that's one of the reasons why we're not lowering the rates. Now, today we are still in a situation where our financial savings are not increasing. If you look at bank deposits, it's fairly lackluster. You look at the other kind of savings avenues going into, say, provident funds or insurance, it's more or less static. So I think this is some point which we are missing suddenly. So I mean, we don't have that consistency in the policy saying that if savings was one of my objectives maybe 2 or 3 policies back, has it ceased to be an objective today? So that's just an observation.
But there are always dominating drivers in each policy, right? I mean,
No, but we're doing
been-
nothing now. We
Yeah.
also did nothing a couple of state policies back when we said that financial savings was a concern for us.
Okay, fair
Especially
enough.
with inflation.
Mr. Srivastava, what stood out for you in the policy?
So, I mean, I think one of the major points which Madan has raised, and that is very important also from the fact that we have seen this over a period of time, and now also that this savings rate is not increasing, and unless it increases, is not going to aid the growth of the economy. And RBI has been focusing on the real rate of return, but that has not actually attracted any kind of money into any of the, or they have not changed the equation. So the net disposable income, so the income growth is, I think, the thing which is hurting the economy right now. And that is something which RBI will not be able to do anything about, and they need to focus on growth. And they have also been, I think, on the other point is they have been shy on increasing the supply of overseas buyers out here in India. I mean, if we compare with the Asian Pacific economies, which range anywhere between 25% to about 50 or even higher in the Southeast Asian economies, India is just about 5%, which will be by 2018.
No, 5% of what?
Of the
sovereign-
outstanding supply.
Yeah, okay.
So when their outstanding supply is close to about anywhere between 25% to about 70-75%. So the point is that India should allow these investors to come in, and these yields are good. The fiscal control of the government is good. So this will help in aiding the borrowing program of the government, and also lower down the yields.
On
which
the
will,
savings front, Mr. Srivastava, just to go back to that point, what do you like to
So
see?
the savings point is that, see, the point is that this is not the point that real rate of return is the only thing. If you look at it in India, even targeting a 1.5 or 2% real rate of return is not helping. So the point is that this is not the problem. Problem is probably the net disposable incomes or the income growth. So that is the point which they should focus on, and they should be a little more aggressive on the point that they should let it go a little lower. It doesn't matter as of now.
The rate, you mean?
The real rate of return.
Right.
So that is the point which I'm trying to drive at.
You'd agree with that, Madan? Don't focus on that 1.5%.
No, to my mind, I think if my financial savings don't see, on one hand, we're getting worried about people putting money in
No,
gold.
he's making your point, but from coming to it from a different.
No, but we're talking of
yeah.
1.5 to 2%. To my mind, is still a low return, because
Yeah.
considering the fact that your CPI inflation number is not something which any household would identify with.
Yeah.
In fact, if I go to any housewife and say that inflation is coming down at 5%, she'll probably say I'm talking nonsense. Say you go and run my household with the kind of inflation which we have. The fact remains that because of high inflation, especially on the food side, which doesn't get captured in our CPI number of 5%, I have less money to spend on non-essentials. I have less money to save, and that's the kind of a repercussion which we're facing today.
Atul, you want to weigh in on the savings bit?
No, it is a fact that the disposable incomes are reducing in the hands of the people, and the real inflation is not captured, which I do agree with Madan, and that is the impact that we have on the savings rate. As far as the point on reducing the small savings rates by the government for transmission by banks, I do not agree with that point of the governor. I think it is misplaced both in terms of the magnitude of where the savings are, and also where the history looks at. 2004-2005, we had banks savings rate at about 6%, and the PPF etc. were at about 7.75-8%, and still the bank deposits were growing a healthy 34-35%. So I do not agree with that comment of the governor.
Mr. Chaudhary, to you, sir, on the point of the onus now lies not only on food inflation, etc., but also the government doing something on the small savings
First,
rate.
a very
Yes.
valid point was made that how to raise the average disposable income by raising income. Now, world over, people know that income rise happens through growth in jobs. And growth in jobs will happen through growth in investments, and only when the investor or the company thinks that there will be a profitable return on this, they will make the investments. And today, if you look at the capex cycle, if you particularly look at the order book, you know, a BHEL or L&T, it is as dismal as it can be. And the governor, to my surprise, made a mention that, you know, there is a pickup in construction activity. But you see the number of construction companies which are making a beeline for getting the SDR or getting their loans rescheduled and all of that. So where is the boost in construction coming from? Secondly, the point about, you know, the money will flow where the returns are high. Nobody is as dumb today. And I would suggest this people on this panel to make a visit to the post office and just see for themselves how busy the post offices are. And secondly, they have also technologically improved, so they are doing brisk business, but this keeps the cost at a structurally high level. And if you reduce the PPF rate, particularly there is no justification for 8.5% rate, that too tax free, and see the amount of tax waiver you are giving in the tax free bonds and in PPF, what a cost to the economy it is coming to. So if these rates come down, surely the banks can bring down their cost and then pass on the benefit of lower lending rates.
No, but when you say structurally high, what do you mean structurally high?
Structurally high means, you know, you have to have a benchmark. When you put a deposit in a bank, you take a bank risk and you get 1% more or 2% more and go to government, which is absolutely infallible in terms of the local currency indebtedness. So which fool would go? And 2004 to 5, if you see, the banks started raising their deposit rates at 6.
No, that's the, Mr. Chaudhary, that's the point he's making, that given all the advantages of going to the government for this 8.5%, the small savings is only about 5% of the overall bank. Bank
because
deposits,
you
right?
know,
So
because it has happened till recently, last 3 months back, the bank deposits were competitive vis-a-vis the small savings rate. If you inverse the structure, this growth will disappear. And secondly, you know, the talking about allowing foreign investors to participate in domestic, it's absolutely fine. But why do it on rupee rates? Which country passes on its higher rate of interest to the foreign investors? You offer 8% to the foreign investors and allow the currency to only depreciate by 5.5%. This fellow walks out with a 2.5% absolutely safe return, and that is money for jam. And you look at all the commentaries of most of the large, you know, foreign investor houses, they are saying the best investment in India is fixed income. Nobody is saying it is equity. It is saying fixed income. Now, if you want foreign investors to come in, why don't you issue sovereign bonds? Today, the 5-year treasury is something like about 1.25 or 1.4. And if you allow the India's makes a sovereign debt issue, I'm sure it would be able to get at least $20 billion at 3.4, 3.5%. Instead of doing that, you allow them to come in and give them 8% return on a platter, and they have the assurance that the currency will not depreciate more than 5.5%. So they walk out with a safe and secure return. Secondly, please look at the trade deficit. I think the trade deficit number is a clear pointer of competitiveness of the economy vis-a-vis other economies. And the way the trade deficit is growing, in spite of the drop in the oil prices, is a clear pointer that we are losing out in competitiveness to other countries. So, by all means, do a sovereign bond issue, and in fact, the sovereign bond issue will be much better, because in a sovereign bond, the mutual funds, the insurance companies, everybody can participate. Whereas in this kind of, you know, restricted access, only the institutional investors are participating.
Mr. Pan, Indranil, I want to draw you in on the small savings bit. Your thoughts on that? Mr. Pan, are you there? Can you hear me? Okay, I think we're getting him back. Atul, you want to come in on the last point that Mr. Chaudhary made on the bond issuances?
See, on the bond issuances, I strongly feel that it's good probably to do a sovereign bond issue. But in the times of crisis, are you able to manage the currency or the CDS swaps? We saw in 2008 that the largest banks, both on private sector and in the public sector of India, had that CDS swap rates going all the way up to 12%, virtually indicating that these were junk bonds. Now, that is potentially something that can happen to India's sovereign bonds in times of crisis. So would one want to run that kind of risk when you have such a small balance sheet globally and with $350 billion of volatile reserves, which is all hot money to a great extent? I do not think we should venture out into the sovereign bonds. I think if the governor is saying fiscal is a joint responsibility, it's time to perform. We really need to figure out ways and means to kind of reduce the interest cost home, make our balance sheet stronger, go in for an upgrade, and then look at a sovereign once you are into the A category with a much healthier reserves to protect your currency and your bonds, both onshore and offshore.
But will we be ready to do that? I mean, if the basic risk is to, in times of crisis, if we would be able to manage it, how far out are we to be able to do it?
I think it's several years away from present times, and I don't think would be a very wise decision to go in for sovereign bonds at this juncture.
Mr. Chaudhary, you want to come back?
I think we should like to fall behind countries like Indonesia. You look at any country, Indonesia, Philippines, Mexico, Egypt, everybody has done a bond issue. And if the sovereign bond, even if the government has not issued, SBI, IDBI and ICICI, so many companies and many other PSUs have done. But nowhere where they, so long as the country was reasonably solvent, the country's repayment capacity and the exchange reserves were comfortable, nowhere did they find a bottleneck of this kind. And even if this kind of bottleneck were to happen, even if conditions were to become difficult, how do we think the rupee bond would be not vulnerable? And all these rupee bonds carry the responsibility of repatriation. So if you have a situation theoretically discussing that the India's country rating falls, the India's global perception falls, then even the rupee bonds would be vulnerable. My point is, when you can borrow at 3.5, why are you offering 8%? And secondly, why did you offer subsidy to the high net worth NRIs to get FCNB deposit at 3% plus the normal rate and push this with a subsidy into the system? So there is a tendency to, I think, unfairly and very generously reward the foreign investors. I don't think, they should get.
No, but with the benefit of hindsight, of course, we can criticize Mr. Chaudhary, but you and I have discussed this when this was happening,
Of course,
right?
And I never offered higher rate, no.
SBI.
I never offered higher rate on FCNB. This was a sheer, this was a racket going on, if I may use the expression. The people were taking leverage positions, putting $1 million, taking a $10 million loan and putting money in India's FCNB at 3% over the normal rate. Who paid? The country paid. The poor people paid.
Mr. Srivastava, yeah.
The point here which I would like to highlight is probably RBI wants to let it be market decided. Okay, so that's the point. The point is that you go out and issue at one rate. Okay, do a lumpy bond issuance at one point in time. So whenever we need that, when there were discussions about the time of crisis in 2013, when Dr. Rajan had joined.
Yeah.
And there was a hot debate about doing a sovereign bond issuance, overseas sovereign bond issuance, and I think they came up with a ingenious solution at that point in time, because if we would have done that, CDS rates, everything had exploded at that point in time, and it would have cost us quite a bit. And the FCNR issuance was a success at that point in time, got us cool $34 billion. And at this point in time, I think it is not needed. We are not in such a situation, number one. Number two, it's market determined. Whether they are earning 2% or 3% today, what will they earn when they repatriate? That is the point. Market will decide that. What will be the rupee situation? What will be the interest rate situation?
Sure.
Yeah.
Sure. Got the point.
Why did
I'm being
RBI
told to
have
wrap
to pay a
up.
subsidy? Why did RBI have to pay a subsidy? If the rates are market determined, raise the FCNB rates. Why did RBI have to dip into the central exchequer, government exchequer, and pay a subsidy? Why don't you pay the similar subsidy to the people who are depositing gold? Why this aversion? Gold is equivalent to dollars in the international market at a particular price point. So you give a similar subsidy to the people who deposit gold, saying that I did it to FCNB. And FCNB, those who know, every single deposit that was made was a leverage deposit. Because nowhere in the world...
I agree with that. And we actually reported on that as well. But the point is, on a lighter note, Mr. Chaudhary,
it's a scam.
Somebody was telling me that the RBI statement from policy to policy doesn't change very much. I must
where
also
they
say that
should move.
your criticism of the
the
RBI
thing
from
is,
policy to policy
where
also
they
doesn't
should
change very much.
where they should move and would be to the overall good of the country, they move at a snail's pace. And where it is to the detriment of the country, like withdrawing the dollar LIBOR financing for export, it was done overnight.
Mr. Chaudhary, it's always a pleasure, sir. We learn a lot from you every time. Thank you for joining us as always. Mr. Srivastav, thank you very much. First time, I hope you're a regular. Atul, thank you indeed for your time. And Madan, as always, thanks very much. I think we lost the line with Indranil Pan, and if you can hear me, Mr. Pan, thank you for your time today as well.